Happy Super Bowl Sunday, y'all. As promised, I'm going to do this week's video tutorial on what the market did this past week. The market was primarily concerned with the coronavirus, even though you had earnings reports come out on some of the big heavy hitters, such as Apple, not Google, but Facebook and Amazon. They all had earnings reports this week, but most of that was trumped by the coronavirus. So let's look at a few stocks. By the way, I did not do any trades this past week. I've learned throughout the years, once the market is overwhelmed with fears of something, it's best to play the sidelines until those fears are resolved. So no trades this past week, but let's just look at a couple stocks and see what it did. Let's look at Apple. Apple reported on, I want to say, Tuesday. Or it may have been Wednesday. But it was a favorable report. On Monday, it was at 308.95. And then on the day of the report, it closed at 324. So it went up almost 5%, only to go down 4.5% on Friday. You see this 2 days, this drop. This is when the news hit with the coronavirus and the market dropped. So although Apple had a good earnings report, favorable, it still was affected by what was going on with the virus. Let's look at Amazon. Amazon reported on Thursday. And as you can see, Thursday it closed at 1870. On Friday, it closed at 2008. So it went up 7%, a little over 7% advance based on its earnings report. And if you look, these are the contracts, the call contracts, where you're speculating for Amazon to go up. Had you gotten any of these, it would have paid off handsomely. Look at the 2000. Remember when I put my cursor on this bar, look at this box here. You can see that contract closed at $296 for that contract. Look at what it did on Friday. 6,465 was the open. That's where it opened at. So a contract that theoretically you could have been in at $296 Friday morning hit $6,000. It ended up closing at $1,000 on a almost $300 risk. You could have made, even if you would have held it at the close, you would have still been up considerably. But at the open, it hit $6,000. All right, let's go to Facebook. Facebook surprisingly was a disappointing report. The street didn't like, what Facebook had to say in terms of guidance. So Facebook sold off. It reported on Wednesday, and it closed on Wednesday at 223. By Friday, it was at 201. So, it sold off in 2 days, almost 10%, a 10% drop. If you look at the contracts on the way down, if you were planning for Facebook to go down, let's just say you were in the 210 contract. On Wednesday, that 210 contract, that was $125. On Friday, it closed at $831. So from $125 to $831, you would have made 564% return on your money on just one contract. Now, let me explain. You can buy as many contracts as you want, but for money management purposes, you never want to go over a certain percentage of your account, because remember, the name of the game is to be around for those winning trades. So you must survive the downturns. You must survive the losses that will come. But when you survive those losses, it will have the capital available for you to be in these types of trades. Unfortunately, I wasn't in these trades because I was on the sidelines, because of the virus. But for, educational purposes, just so you can see what this market is really about, I thought that I would do this video. Let's look at this other stock, Tesla. Tesla reported on Thursday, and it went from $580 to $640 on Thursday, to $650 on Friday. So even though the market sold off, Tesla held firm. They even bidded it up $10 more. So Tesla right now is a high flying stock. Tesla is a stock that I've made a considerable amount of money in last year. It always gives great trading opportunities. So I'm just simply waiting for that next opportunity. Had you these options now, when stocks report earnings, these contracts tend to be very expensive. The reason for that is because of what is called volatility. Volatility can drive up the prices of these options because there's people speculating on the up and down. So once the volatility increases, the price of these contracts increases. The premium that you pay for a position will increase. So a lot of times during earnings, there isn't any opportunity to make money. The risk reward ratio is just not in your favor. So it's best typically to wait after earnings when contract levels go down in terms of the premium that you pay. But there are some times where you can make money during earnings season, like I just showed you with the Amazon and even Facebook. You could have made money in Tesla as well. Let's look at a contract. Close at 580. Let's see. Let's look at the 640. Listen, you can see how expensive these contracts are. Look at that. It reported that this contract was at 1,050 when as high as 1,800. Let's see if we can find something cheaper. So you can see how the volatility drives these prices down. Even though the stock went up and you betted for it to go up, if you bought these highly expensive contracts, you would have lost money. So a lot of times it's not even in your interest to buy options during earnings season around a particular stock, because, like I said, the risk reward ratio is just not in your favor. I will be doing another video diving into the charts and what they represent, what these bars mean, what these little horizontal lines mean. They all mean something. So I will explain it in more detail in the next video. So happy Super Bowl, and look forward to the next video. I've been getting your DMs, your messages, and trying to answer the questions that you have pertaining to this. So if there's any other questions that you may have, just DM me and let me know. All right, thanks.